Was good. I hope everybody had a great Halloween weekend, stayed safe, spent time with friends and family. And I hope y'all are all locked right back in for this week and cutting out the BS. I know it's a holiday. A lot of people went out, had some fun. That's perfectly cool as long as you could bounce back right away. So let's just bounce back, get right back into that mode, and continue on. So today I want to go over the importance of inverse fair value gaps and fair value gaps and when to use it and when to look for each one. I'm sick as right now. Got my tissues. I'm sipping on some tea. However, the work does not stop. The grind does not stop. Man, everybody gets sick. I just got to tee up and continue on. I made some like chai tea. I put honey and lemon in there. If you're sick, that's the remedy of the gods, man. I'm telling you. But I want to show you how to use imbalances the right way and when to use them in some drawn up examples and then also in some real life market examples. So I want everybody to really ask themselves, do I understand liquidity and imbalances in the stock market? And do I understand time frames in the stock market? If you understand the basics of imbalances and liquidity, you will be okay and you will be fine. And I'm just gonna kind of breeze through this video, and I'm done kind of taking the beginner steps of like, okay, this is a fair value gap, this is a liquidity pool, because I made videos on all of that already, and just go back and watch them if you're confused. But other than that, I kind of just want to get right into it. So we have a low here, we're grinding in an uptrend, boom, boom. We break structure here, we create an imbalance, and then we sweep a low. Now, is this a fair value gap? I want to ask you guys, is this a fair value gap that you would want to look for puts out of? Is this a fair value gap that you would want to see price come up, fill, and then continue down? Is that what you would look for here? Now, if you said yes, you have to reevaluate liquidity and imbalances one more time because we just swept out a low. We just swept liquidity. So we have to realize and understand that this imbalance is now used for an inverse. Because if we sweep, let's say we're on the daily, we just swept the daily low, we want to look for a move in the opposite direction. Because we know right here there's tons of orders waiting to be filled, stop loss orders, right? Buy stops, or I'm sorry, sell stops because they're buying, and in order to get stopped out, they would have to sell. So these would be sell stops. And we know that they exist underneath this low because why? People went long right here, right? People went long. Let's say there was some type of entry liquidity sweep previously. Boom, they found an entry in here. Where is their stop loss going to be? Underneath that low. And then they're going to be targeting, previous highs, whatever the case may be. Let's just say there's some highs right here. Whatever the case may be. So when price decides to come back down and sweep out that low, that means that everybody who went long just got stopped out by that candle, right? They just got stopped out. So all the buying momentum is starting. Sorry, all the people who bought got stopped out, right? Making more room for big money, making more room for these banks to get into the market. So why would we look for this fair value gap to get respected to the downside when we just swept high time frame liquidity? We should tell ourselves we're looking for the inverse. We are not looking for it to get respected. We just swept high time frame liquidity. There's a lot of orders that just got stopped here. Price should react upwards. So we should look for, maybe we come in, we respect it for a minute, and then boom, we should look for a giant move above this imbalance. Now, let's just say, okay, this is a picture perfect scenario. We just swept out a low. We just inverse the fair value gap. Now, typically, when we inverse a bearish fair value gap or when we inverse a fair value gap to the opposite direction, we create a new fair value gap. So, most likely, if this is our fair value gap, we just broke through it, indicating, okay, The sellers are in control here. Now there were only sellers in this box, no buyers. So for in order to us continue the downtrend, if we are bearish, we would have to come in, respect this imbalance, fill it entirely, and then continue to the opposite direction. But if we just blow through it, it's telling us, guys, the buyers do not care, right? The buyers are not trying to balance price out. They're simply ripping right through it. So now's your opportunity to hop in because the buyers are in control right now, right? And with trading, you don't care about tomorrow. You don't care about the next hour. You don't care about the next day. You care about what price is doing now. At least for my strategy, I'm in and out within 5 minutes to 40 minutes, an hour the most, right? I'm in and I'm out. I just care about price right now. Now, this is perfect. We swept out a high time frame low. We inversed a fair value gap. I guarantee you, right, if this were real markets, we would probably make a new fair value gap somewhere in here. That's when we would look for our pullback to the new fair value gap, right? We swept out sell side liquidity. We inversed a bearish fair value gap. We pulled back to a bullish fair value gap. Maybe we break 1 minute structure, we do it again on a lower time frame, we inverse a 1 minute fair value gap, whatever it might be. Say we chop a little bit, whatever, boom, that would be our entry. Our position would look something like this. Stop maybe underneath this low, targeting previous buy side liquidity right here. Now this would be our beautiful trade. So most people look at fair value gaps as, okay, let's respect it and go in continuation, right? It's a continuation confluence. It's a continuation play. That's all it is. But you don't realize you have to understand when to use it to the upside as well. Because let's just say, boom, let me get rid of this. Let me get rid of this. Let me get rid of this. Let's just say, let's just say this first time, boom. Let's just say we come into this fair value gap for the first time and we respect it. And all these retail traders and a lot of people are looking for shorts in here, right? Stop above the fair value gap, targeting more sell side liquidity. Say they go short right here. Of course, maybe the first time we tap into a fair value gap, we're going to get a rejection out because, guys, it's still balancing price out. There still is no orders here until we fill it. So, mechanically, algorithmically, as soon as we fill it, we're most likely going to get a reaction to the downside. That doesn't mean it's going to be a huge one. This could just be a singular 1 minute candle or 2 minute candle retrace to the downside, and then oh wait, and then we decide to rip right through it. And how would you know we're going to rip through this fair value gap? Well, because we just swept sell side liquidity. Okay, so you have to understand when to use it. Now, if price looks something like this, right, and this was our low, this was sell side liquidity, then you might stop and say, hey, we have sell side liquidity here. We're clearly bearish. We're generating more liquidity by putting in this low as well. We just put it in another low. This is generated sell side because we know the market moves for 4 reasons: generate liquidity, hunt liquidity, rebalance to equilibrium, and rebalance to inefficiencies. That's all the market does. So if we're generating liquidity to then take it out and we're filling in a bearish fair value gap, now is the time where you can look for shorts. Now is the time where you could say, hey, okay, this makes sense, right? Algorithmically, this makes sense. Technically, my technical analysis is telling me, okay, we're going to want to take out these lows. I'm sorry, that's an awful drawing. But the point is, you have to understand where price is relative to the model. Where is price relative to the model, to the structure, to liquidity, to the imbalances, right? I'm going to make this a little bit cleaner just because it is pissing me off. Okay? We have to ask ourselves, where is price relative to the model? You have to understand external versus internal draws and liquidity. You have to understand imbalances. Okay? If we're generating sell side here and we come into an imbalance, we're most likely going to respect it to take out sell side. But, like I said, if we already take sell side out and this is our low, then why would we look for more downside when sell side liquidity has already been taken? So you guys have to understand the model. You guys have to understand the high time frame picture, okay? And when to use fair value gaps. Because this fair value gap, if we swept liquidity, is good for an inverse. But if not, it's good for respecting it. Let's hop into some charts, man. Let's hop into some charts. Now, price action has been so bad these past few weeks. I'm probably just gonna go back a few weeks because I doubt I can even find examples. Like price action on the high time frame, of course, it looks like decent, but Jesus, we're electing a new president on Tuesday. Today is Sunday. So today's Sunday, November 3rd, 2024. We're electing a new president. It's either going to be Trump again or Kamala Harris, the first ever woman president, which I'm not going to say too much. I'm not going to say too much at all because I don't really care. I'm literally just going to go to a random spot on this chart. And let's just see if we can see what I'm talking about. Okay. Boom. We have equal highs right here, right? One, two, three, four relative equal highs. Boom. Look at this. One, two, three, four relative equal highs. What does price do? Sweep out buy side liquidity, creating Jesus, creating a bearish fair value gap. Now, what does price do? We come and we fill this fair value gap. Now, would we look for price to inverse this fair value gap? No. Why? We just took out buy side liquidity. You have to look at the fair value gap. Where is relative to the model? Did we sweep liquidity? Are we generating liquidity? Are we in an inefficiency? Are we in equilibrium? You have to understand the high time frame picture. We just swept relative equal highs. We just broke to the downside, inversing this fair value gap, right? That's a play in itself. Look at this. We create a bullish fair value gap right here. We come up, we sweep buy side liquidity, inversing a bullish fair value gap. This inverse is telling us we want to go lower. We are not respecting buy side anymore. The buyers were in control, now the sellers are in control. We don't care about buyers no more, right? We're supposed to fill this and continue up when we just ran through it. That is confirming that sellers are stronger. Then what do? Boom. Liquidity sweep, inverse. Then what do? We pull back to a regular, newly created bearish fair value gap. Respect it, and then sell off. What do we do again? Create another one right here. Respect it, sell off. And yeah, guys, but the only reason you can look for downside is by realizing we just took out buy side liquidity, inverse the daily fair value gap, pull back, respected it. It's clockwork. It's clockwork, guys. It is clockwork. Let's find another example. Bad example, bad example. Yeah, price has been so bad. I'm also on the daily, but whatever. I want to find an example of like I just showed you a sweep and then an inverse. I want to show you. Let's go down to the 4 hour. No, any wait for somebody or something to show them what's up. Might not even making this problem. Okay, so boom, we have a 4 hour high right here. We sweep it. We have a fair value gap right here. Sweep the high, inverse the fair value gap, pull back to our newly created fair value gap, which is right here. Pull back, respect it, and what do? Continue our sell-off. Now, I'm on the high time frame. This happens a lot more frequently on the 5 minute, on the 15 minute, on the hourly. But I'm gonna stay on the high time frame because price has been so ass lately. And the high time frame is really the only thing that looks semi-liquid and semi-smooth. But anyways, boys, I really hope y'all learned something from this video. I hope y'all learn you have to understand where are your confluences relative to the model. And once you can understand that, man, you're gonna be golden. I hope y'all have a blessed day, and I'm gonna catch y'all on the next video. Peace.